New tax law could drive your AMT bill up to 42%, but a few smart moves could help you dodge it entirely. I've been hired by wealthy tech executives for the past 5 years to show them exactly how to pay $0 in AMT. So in this video, I'm going to show you why AMT is optional even if you're a high earner, how to avoid AMT while exercising your incentive stock options, and when avoiding AMT will actually cost you more long-term, all in just 13 minutes. To start, let me show you why tax, including AMT, is optional so you can manipulate the tax code in your favor. Imagine the regular tax system is a game of limbo. The goal is to bend lower and lower, squeezing your income under the bar to pay less tax. People got so good at this, Congress realized they were missing out on tax revenue. So they added a twist. Now everyone must compete in a high jump. That's the AMT, or alternative minimum tax. There's a minimum bar you have to clear no matter how good you are at limbo. So how can you keep your taxes as low as possible without getting tripped up by the high jump of AMT? Let's break down how AMT is triggered so you can apply this step by step. This first bar represents the amount of income one must pay in the regular tax system. Let's say it's $100. People got good at tax planning their income down. This person now only owes $30. This is why Congress created the high jump of alternative minimum tax. The second calculation shows a minimum amount this person must pay. In this example, $100. But what does your tax bill actually look like when it comes time to pay tax? If AMT is higher, then they'll pay a portion in AMT and a portion in regular tax. In this example, it would look like this: $30 in regular tax and $70 in AMT. Or on the other side of the extreme, your AMT bill could look like this. You would owe $90 in regular tax and only $10 in AMT. But most people are unfamiliar with AMT because their tax bill looks like this. Let me show you what impacts these two bars so you know how to manipulate the tax. When calculating your tax calculation will look something like this. But let's say you got to this number through an itemized deduction. You did tax planning and did a good job playing limbo. But what AMT does is it takes those things that lowered your regular tax bill down and adds them back into your AMT. It's things like this that trigger AMT. But what else can trigger AMT? The spread on your incentive stock options when you're exercising can increase your AMT. This ISO spread is known as the bargain element and is only applicable in the year where you're exercising or purchasing your incentive stock options, also known as ISOs. This is why AMT is optional, because you get to control the various aspects of your tax bill. But there's one more major thing that affects your AMT. It's called the exemption. Because AMT was only meant for the wealthy doing extreme tax planning, the government implemented an exemption so that most people wouldn't trigger AMT. As such, recent numbers have pegged about 0.06% of the US population as paying the alternative minimum tax. So at the end of the day, your AMT calculation could look something like this. But where does the 42% AMT rate come in? Here's a chart of the varying levels of AMT income. But because AMT is meant for those who have large incomes, IRS has implemented an exemption phase-out to get back that benefit that was intended for non-high income earners. The income levels on the left have the full exemption until it is fully phased out and receives no exemption, as you can see in the far right. For each dollar of income that you receive in the phase out, the IRS takes 50 cents of that exemption back. Essentially, every dollar that you earn, not only is that dollar being taxed, but an additional 50 cents becomes taxed. So while typical AMT rates are around 28% outside of the phase out, your tax rate jumps in the phase out. Here's the math. For every dollar you earn, you expose $1.50 to AMT's tax rate of 28%. If you take $1.50 times 28%, you get 42%. So the goal is to try and avoid earning income in this phase out as the tax rate jumps to 42%. You can see if you're overpaying by thousands in my spreadsheet linked below. Next, I'm going to show you the exact process that could help you avoid the highest 42% AMT tax rate and pay $0 on AMT fast. This cup is your regular tax bill, and the water is your AMT. If the water stays inside the cup, you owe $0 in AMT. But if you pour in too much water, the cup overflows. And any water that spills out of your cup is your AMT bill. The goal is to not let this cup overflow so you can avoid AMT and put that money towards your dream home. So how do you make sure that your cup actually never overflows? Let me break it down step by step. You have two ways to keep your water from spilling and triggering AMT. First, you could grab yourself a bigger cup, making it more difficult for the water to spill out. Let me show you how to actually do this. Increasing your regular income enlarges your cup and makes it more difficult to trigger AMT. Here are some common ways to do that. Buying or exercising your non-qualified stock options, doing Roth conversions, or selling some stock held for less than a year. Please check with a tax pro for the details that fit your specific situation. The second way to make your cup as large as possible is to make sure you don't have anything shrinking it. Remember this chart right here? An itemized deduction both shrinks your cup and pours water into it at the same time. A double whammy. Consider shifting some of your deductions into a tax year where you're not exercising incentive stock options. That means being strategic with your state and local taxes, charitable contributions, and mortgage interest. Which brings me to the second way to avoid spilling and triggering AMT. The less water in the cup, the less likely it is that it's going to spill. Every time that you exercise or buy your incentive stock options, it's like pouring a little water into the cup. So you could consider timing or delaying your exercise to a year where there's a little less water in the cup, so you don't risk it overflowing. If you have multiple groups or tranches of options granted at different times, look for the ones where the exercise price, the price that you pay to buy them, is closest to the fair market value, the current stock price. This just means you're starting with the shares that have the lowest water or gain per share. That way you can exercise more shares without overflowing your cup. You might even have some where the purchase price and the fair market value are the same. Exercising those shares is like pouring air into your cup. There's no bargain element, so no AMT from those incentive stock options. Another way to pour air into the cup is if you're able to purchase shares before they vest, also known as early exercise shares. It's common for the exercise price to be the same as the fair market value on these shares. You just need to ensure that you file the 83B election. Here's one more way to pour air into the cup, decreasing the likelihood of you spilling. If you sell your incentive stock options in the same calendar year as exercising, there's no additional water poured into the cup. This is known as disqualifying disposition. Assuming your stock continues to grow every day you wait, the amount of water needed to be poured into the cup grows. You might think that means go and exercise everything to reduce your tax liability, but there's actually 3 things that are way more important than taxes that I'll link below. This next one takes water from your cup, making it more difficult for the water to overflow. When you sell incentive stock options that previously triggered an AMT bill that you paid, you get a negative AMT adjustment, which decreases your AMT. This could allow you to exercise more shares with an emptier cup. It's like pouring water in while draining it out at the same time. This is known as the AMT negative adjustment. But paying $0 in AMT has the potential to be a bad thing. Let me show you how this works. Imagine driving by a free puppy sign and you say to yourself, what the heck, it's free. And you get yourself a free puppy, and the next thing you know, it has bitten a neighborhood kid, chewed up your couch, and gone potty all over the house. The puppy was free, but it still cost you a lot. Similarly, you can get away with a $0 AMT bill, but it can still cost way more in the long run. Let me show you why avoiding taxes could be expensive. But first, I need to share some good news about AMT. If you triggered AMT by exercising incentive stock options, then that AMT is temporary. The AMT you paid can be recouped. Said differently, AMT isn't just about the tax, it's about the timing of the tax. The government wants their tax revenue now. They don't want to wait 5, 10, 15 years down the road for you to sell your incentive stock options. So when you dodge AMT, sometimes you're inadvertently avoiding a temporary tax to pay a higher permanent tax. For example, one way we avoided AMT was by selling in the same year as exercising. That means that we paid $0 in tax that you would have gotten back to solidify a permanent tax at the worst rate. Ordinary income, which could be as high as 50%. One other way that we avoided AMT was by exercising shares that had very little gain cooked into them. This meant that the amount of water that went into the cup was relatively small. By doing so, you inadvertently take on more risk. For example, which stock costs more? The one that cost $100. And when you invest more of your money into your company stock, you're taking on more risk. Strike one. Next question. Which share has the most value to it? Let me ask it this way. Would you rather pay $30 for something that's worth $100, or would you rather pay $100 for something that's worth $100? The first share is way more valuable from that standpoint. Strike two. Now, which stock is more likely to be sold at a loss? The first share can fall $70 before you're at a loss. The second stock is at a loss even if the price drops $1. And that's 3 strikes. So there are many things to take into consideration: risk, current tax rates versus net tax rates, future tax rates, opportunity cost, exercise cost, fair market value, AMT, regular tax, you name it. You really need a professional who understands this stuff. I don't think an AI chatbot is going to help you unless you know the right questions to ask. But even then, wouldn't know much about your tax circumstance. There's more ways that avoiding AMT can have an adverse consequence, but it's beyond the scope of this video. This is why my financial planning professor would teach, don't let the tax tail wag the dog. Always take the horse blinders off and weigh the costs, risks, and reward before acting. In fact, I sometimes recommend my clients pay AMT. Here's a few reasons. It could give them access to more shares at hopefully a lower fair market value. It prevents them from a big pile of unexercised ISOs at a deadline like terminating their employment or the options expiring. It starts their holding period sooner, or maybe their AMT bill is manageable and they will quickly be able to recoup it. Whether you decide to pay it or avoid it, the alternative minimum tax is only half of the problem. The thing is, AMT is most applicable when you exercise your incentive stock options. How do you avoid getting crushed by the larger, more permanent taxes when you sell your incentive stock options? Watch this video next where I'll show you the simple trick to unlock your tax-free ISOs so you can avoid taxes on the tail end too. Click here to see how it's done.